net is only $500 in interest. You got everything else, which is $39,500, a used lawnmower, and a used truck. But that was the deal. Lisa gets the first $10,500, which includes her $10,000 loan, and you get the rest. You own Multimower, not Lisa. Lisa the lender's money was a lot safer than yours, though. Suppose that the year's revenues had only been $100,000 instead of $150,000. After deducting the $100,000 in fuel, maintenance, and labor as before, you're left with a big fat zero. The good news is that you still have the now used truck and the mower. But that's all that's in the bag of goodies in this case, and Lisa gets the first $10,500. You, the owner, have to come up with that before you get a dime. Unless you can raise outside money somehow, you're going to have to sell the mower and the truck. You probably won't get the $20,000 that you paid for them, though, because they're a year older now. Say you get $15,000. That lets you pay off Lisa's $10,000 loan and the $500 in interest, leaving you with just $4,500. You've lost $5,500 of your $10,000 investment. Lisa's glad she was a lender and not an owner in this case. What happens if you decide not to pay Lisa? That's a bad idea because Lisa has the law on her side. She can make you sell items from the bag of goodies until you've raised enough money to repay her. She can force you into bankruptcy if you won't produce her money. If it turns out that the lawnmower and truck only bring $9,000, then Lisa gets it all. She's out $1,000 of the $10,000 she loaned you and doesn't get her $500 in interest either. That's bad, but it's way better than what you get as the owner. You get nothing. Every penny of your original $10,000 investment is gone. When things go well, it's usually better to be the owner. When things go badly, it's usually better to be the lender. I've simplified the world of sharing rules in our example by only having two kinds of financial claims, loans and residual claims or ownership. That ownership claim is what's called common stock. There's another kind of stock called preferred stock, which is in between common stock and loans. Preferred stock gets paid after the loans and before the common shareholders. We won't spend too much time on preferred stock because it's a much smaller proportion of the market. Loans come in different flavors too. For example, if you pledge specific property, like your house, to secure a loan, then it's called a mortgage. The amount you borrow is secured by the collateral, which is your house. If you don't repay the mortgage loan, then the lender can foreclose and take your house as compensation. Unsecured debt doesn't have specific collateral backing it. For example, if you default on both your mortgage and your credit card debt, then the credit card company can't seize your house. That goes to the mortgage lender. It might not make much of a difference to you. You lose your house regardless, but it means a lot to the mortgage lender and the credit card company. One of them gets your house, and the other gets nothing. A bond is a loan with a specific maturity date, the date when the amount borrowed must be repaid. You might hear that a corporation or a government issued 20-year bonds, for example. Those bonds will pay interest along the way, but the principal, the amount loaned, isn't due for 20 years. Bonds are usually tradable, too. If I buy a brand new 20-year bond from ExxonMobil Corporation and decide that I want to sell it to you a year later, then I can do that. You pay me, and ExxonMobil just changes its records so that the name of the owner on the bond is you instead of me. From our perspective, we don't need to worry about those categories of debt. For the most part, I'll use bond and debt interchangeably. The important thing to remember is that lenders get paid first. Stockholders, the owners, get paid last. As a company does business over time, the goodies in the bag that we call the corporation produce things, be they cars or cornflakes or mowed lawns. Sometimes the goodies make money doing that, and sometimes they lose money doing that. As this happens, the pile of goodies gets bigger or smaller, depending mostly on whether the company earned a profit or took a loss. but the share